All right, here we go. Day 2, planning to profit. You're well on your path. You're well on your way here. Thank you again, everybody, for weighing in with your comments, your insights, your glitches, and your questions. So I want to share some of the questions and insights that you shared with me yesterday, because we're all learning together, right? This is my first challenge online too. So thank you for that. I wrote down some of these questions. So first of all, a little glitch in our system here. And for those of you who've taken the matrix, you know what glitches are. But one of the glitches, I believe in indirect costs, I had not recorded these years properly. So I think I went 2000 to 10, and then 2000, I forgot 2017 somewhere, as if you didn't have any expenses in 2017. So just so that you know, these years, just change them to make sure that they correspond with the years in both revenue and direct costs, and you're good to go. That will not change any of your formatting issues. There was a question that came up yesterday with respect to adding columns here for revenue streams. Now you can, I believe I've included 8 or 9 here, and you can certainly add more here, and your total revenue is going to be acknowledged in the tabs below when we start looking at these tabs, the 2011, 12, 13, 14, and on to 18. But what is not going to show up is that specific revenue stream in these tabs. So in these tabs, I've only accounted for the 8. So if you decide that you want to add additional revenue streams into that chart the data piece, you're going to have to come down here into each one of these tabs and into step 2 and add those rows as well, and make sure all the formatting is the same. I would suggest for this exercise, because formatting is a beast, I would actually just suggest trying to consolidate some of your revenue into subcategories to try to make it fit 8 or 9. But I appreciate the feedback, and maybe for future templates I might include, I don't know, 10 or 12. It's been my experience, most people just have one revenue stream, and that's called sales. So I'd love to hear back from you on that. Another question that I received from you guys is, what if you don't have any multiple revenue streams? What if you just have sales? For this exercise, for charting the data, I don't want you to even give that a second thought, right? We don't need to worry so much about what was happening in the past with respect to your sales and your revenue buckets. It's great to know, but most of you, 90%, well, maybe 80% of businesses out there haven't necessarily put their revenue buckets together. That's the work that we are going to do on day 4. So if in the past it was all lumped together in sales, do not worry about it. Just put your total sales number in under the line sales. You'll see that was very similar to this example here in this construction business, ABC, that for many years, they just had everything lumped in one bucket called sales. So at least we knew what the sales were, right? And at least that we were having some sales. So again, that's what I'd like you to do. What was another question? Some of you have been looking for where to put the cost of goods. So cost of goods, it's also known as COGS. So your direct costs, otherwise known as cost of goods sold, COGS. So in your template, it's right under your revenue stream here. Another question that came up is, for many of you, this was a good catch actually, for many of you when you first started in your business, or if you have decided to adjust your fiscal year, you may have a period of time in which your sales were only for a specific number of months. So maybe for your first year, it was, 2013 or 14, and you were only operational for 9 months out of that scenario. What I would actually probably encourage you to do in that case, just so we know, we can do a, I didn't really think this through, but I think what I would do in this situation is I would take your 9 months total and I would divide that by 9. so that we start getting a monthly average with respect to percentages, so that we can see if there's efficiencies there. So you have a couple options. Just don't include it at all. Include it as a monthly total, or monthly average, sorry. Or we could also include it as a year average, because we would divide it by 12 and then divide it by 9, multiply it by 12 to get us the year, but then our revenue is going to be thrown off on there. So at this point, either leave it or just put it as a monthly total, knowing that your revenues are going to be skewed, but at least you'll get a sense of your operational expenses and cost of goods as a percentage. Jared, hi, thanks for the question. Yes, you're absolutely right. We were talking about that before we went live. This default view on charting the data is a nightmare. So I am going to look, if you have the answer to that, I know Sherry mentioned it's under view. I'm going to figure out, we've got the freeze panes. I'm going to figure that out, and I'm going to give everyone a fix to that, so that once you fix that, this scroll bar on the bottom, it's like our little Planning for Profit angels come out again. They come out and they celebrate that we can get around this tool. So thank you for that. I think that will be definitely helpful going forward, and I'll figure that out. Thanks for that feedback. Okay, I think those were the majority of the questions. Feel free again to put them in the chat. If there are any other questions that come up as we go through this today. Okay, so now we have our data charted, hopefully, right? Again, this is a work in progress, so I don't want you to worry so much about what we are doing today, yesterday, and today. This is all historical. We're going to be taking a look at historically what was happening, because today's exercise is called the highways and the hazards. I'm going to come back to Jared's comment here, actually. Window section along the top menus. Okay, thanks, Jared. Jared's got a fix for us on how to figure out this default view, so I'll come back to that at the end here. Okay, so today I'm going to catch my breath. Today we are doing highways and hazards, and we want to be able to look at and analyze the data that you charted yesterday. If you didn't get a chance to finish it, today is your day to finish it and then take a look at it. So what I'm going to encourage you to do, I'm going to come back to my my example. Well, actually, yeah, I'll come back to the example because it'll show us exactly what's going to happen here. So yesterday you were over here in chart the data. See what happens if you look at my screen. You see how everything just nicely comes along? That's because I don't have any frozen panes in the step one. So I know I can hear you right now saying, well, we didn't choose the freeze the panes, you did. So I apologize for that. I'll fix that. That's another little glitch there. Okay, so data's charted. Now the next thing that you can do is year over year, you can start to take a look at, and I can see that I've shifted some things around here. Now I'm just making a mess. You can start to now look at your annual snapshots to just take a peek at what was happening. So what happens here is, for example, in 2010, it's taking the revenue that you charted yesterday, which was your total sales, and it's converting it into a percentage point. Now at this point, because everything was lumped into sales, it's saying, oh, 100% of your sales was from sales, right? So you can see why it's important that we actually start to break these down a little bit. Then we get into direct costs, and direct cost is doing the exact same thing. It's taking all of the dollar values that you entered yesterday, and it is converting them into percentages. So it's interesting because wages and benefits, we can see that that was 45% as a percentage of the total sales, right? Subcontracts, again, 4.89% of total sales. So in this example, you can see here that when we have one bucket for sales and one bucket for cost of goods, we're starting to understand exactly what the cost of goods are, but we haven't broken out the revenue streams. And again, we just have one bucket for cost. So we're getting some information here because at least these are broken down. Sometimes many of you might just have cost of goods, and they're not even broken down between materials, subcontractors, wages, and benefits. Again, I don't really want you to stress about the history and the past. We're going to know better and do better starting tomorrow when it comes to understanding our true operational expenses. So you're just going to take a look at the percentages, kind of weigh in on them, check in on them. Our gross profit is just our income, our revenue, minus our direct costs, leaves us with a gross profit, minus our direct costs then of team, space, sales, and other, right? In this case, it was 39,000. Now we see where the negative came in. Now, hopefully this is starting to make sense for you why I break down the expenses into 4 buckets. Because if we have a flag, right, if our operating expenses are super high, now in this case, operating expenses really of 18%, I wouldn't say that's high on average, right? That usually we're looking at operating expenses of anywhere from 50 to 80%. So this is actually quite low. But when we have flags, we know that right away we can start to look into which category, into which bucket do we really need to start digging in. When it's a general ledger of 35 expenses, it becomes very hard to start to pinpoint where the issue is. So this makes it a little bit simpler. So all you're going to do is year over year. You don't need to, spend tons of time on this, but it is kind of interesting to get a snapshot with respect to your dollar values. Year over year, you just take a peek. And then today, this is what we start looking at, the highways and the hazards. So there's a couple things that I'm going to get you to focus on today, and I'm just moving my little dashboard here so I can be present with you and not distracted. Here we are on the highways and hazards, and I think several of you probably jumped right to this after you charted the data, because this is kind of like Christmas, right? It's like, oh, I want to see what's going on here. So the whole intention of this exercise is to learn from the past. For many of you, this is probably the first time that you've ever seen your numbers side by side like this. It's definitely, not definitely because I don't know your situations, but it's probably 99.9% the first time that you've seen your numbers converted into percentages as a percentage of your revenue, not change from the previous period, right? So the only percentage here, if you look at line 16, percentage of change from the year previous. This is the only percentage point that is actually calculating based on looking at a previous period. That's it. Every other percentage point in here is based on the revenue of that year. So when you start to convert this and when you start to look at your numbers from a percentage perspective versus a dollar perspective, I say it's like the runways light up. Right? It's like, whoa, what the heck was going on? So usually kind of the first thing that I recommend, well, I usually go right to the bottom line. I'm like, okay, what was going on? Now, you'll see here in this example, this is actually quite common, that a lot of people don't know what their expenses were for that previous period because they're waiting for the notice to reader from the bookkeeper. So again, kind of a flag, I would write that down to say, okay, no more waiting. We need to know every month, in the month, at the moment, exactly what's happening financially, right? So lesson number 1. Lesson number 2, when you look down here at your net profit, it's kind of like a moment of, okay, what was working and what was not working? Because oftentimes these net profits, again, do not get communicated as a percentage of revenue. They get communicated as change over last year or last previous period, right? So in this case, it's like, whoa, this company ABC, 18% net profit, that's pretty good, right? -14, -14. So it's interesting because, in my one-on-one coaching that I do with people, once we get everybody set up and they start executing on the strategy that we've built to be profitable, now they have to be held accountable and they need to execute. And many of these customers, clients, will actually form advisory boards. So it's basically like a board of directors, but they're all advisors. No one's getting paid. We get together quarterly. Sometimes there's an annual meeting. But these advisors are going to be asking very specific questions, holding you accountable for fiscal performance, right? Financially responsible for fiscal performance of the business. So the questions I am about to ask you, which I'm going to share in an email with you today, are the same questions that any board, regardless of whether it's a board of directors or a board of advisors, these are the questions that they would be asking you. But more importantly, these are the questions that you should be asking of yourself and your team if you have one, because you are the owner of the business and you need to own the decisions. Oftentimes we look to bookkeepers, right? We're like, oh, what should I do? What should I do? The bookkeepers are there to chart your data. Sometimes we look to accountants, and there are definitely consultants out there, accounting consultants, that will help you with some of these numbers. But for the most part, the role of the accountant is to mitigate your taxes, right? So in some cases, oftentimes, they're going to be encouraging you to have a lower net profit and to start taking that net profit and investing it in different things. And I'm going to show you why sometimes that isn't always in your best interest, because you're going to see exactly why that's going to happen here, because that's what happened in this situation. So when we start looking at this net profit, it's about, okay, well, what was working and what wasn't working? Like, why did we get an 18.49% profit here, right? Like, what was going on? And you'd be fascinated to learn that, especially earlier on when we start a business, we tend to be, at least it's been my experience, that we tend to be most effective, right? Now, oftentimes we're also not paying ourselves. So this is something to watch for. If you had a huge net profit one year, was everybody properly compensated, including yourself? So something to look for. So again, so if we're taking a look at what happened in that year to work, first of all, their revenue growth jumped 142%, right? Great revenue growth there. Let's take a look at their cost of goods. So their cost of goods, if we look at 2010, their cost of goods were 82%. And then in 11, it actually jumped up to 65.98%. So they actually, or sorry, it went down. So they decreased their direct costs or cost of goods. So that's interesting. They made more money. They decreased their cost of goods. And then let's take a peek at what happened here in their total. Oh, I'm sorry, everybody. Yeah, okay, sorry. Total direct costs. So team and personnel, 1.37%. So that went up a little bit. Space and operating remained flat, right? 8.77, 8.45. Sales and marketing went down, and miscellaneous expenses went down. So overall, they created a lot of efficiencies here. Now, this is where only you have the answers to this. Your bookkeeper won't have the answer, and your accountant won't have the answer. It's like, where did you create the efficiencies? What happened here that you were able to actually reduce cost of goods and reduce operating expenses to get you in at a profit, right? You have to figure out those answers, because those are the things that we want to start to duplicate. One thing that's interesting here, you will see that team and personnel, 0.55, 137, 1.35, 0.89, 0.22. I can tell you right now, you cannot operate a business, even an online business, at 1% of your total sales being allocated to personnel. So then the question is, are we missing an expense here? And under wages and benefits, this is where they have put their wage and benefit. They had put it as a cost of goods sold. Now, that's not necessarily a bad thing. What is interesting, though, is that when we add up wages and benefits of 26.15 plus this one, we're looking at approximately 28% of revenue was associated to wages and benefits. And I have to say, in my experience, on average, your two biggest cost centers are usually your team and operating expenses, your space and operating. So I usually look for anywhere between 20, 25, 30, all the way up to 38, 40% as a percentage of revenue attributed to team and personnel. So now this is making sense for me as to where their wages and benefits came from. Here's a little bit of a tip, though, that I want to share with you. If you are the owner of the business, I am going to, and you're accounting for your wage. So in this case, these are two partners. They own the business, they're partners in the business, and they had been putting themselves, they'd attached their wages to a project, which is fine. But if you've gone through the matrix with me, you know that your life does not operate on a project basis. You have to pay your bills every month, you have to pay your mortgage every month, and you have to get food on the table every month. It's not okay to say, oh, well, you know, it's every 3 months or 4 months once the project is done that I'm going to bring home money. So I'm going to encourage you for this exercise that you should be adding your monthly salary, draw, dividend, whatever it is that the business needs to pay you to have sustainability at home. We need to show that as an operating expense, because you cannot be going feast and famine. You need to have consistency. So just as I did with these guys, I'm going to encourage you to move your expenses, move your salaries down into team and personnel expenses. Okay, so now we kind of know what was going right for them here. In this case, there were a lot of efficiencies. There were some minor efficiencies, but more importantly, what they did here was grassroots marketing, sales and marketing. I'm going to come back to this in a moment, but I find this also quite fascinating because it's in those early days when we are most, I don't want to say desperate for sales, but when we first launch the business, we're really excited. We know we need to get business in, that we're most apt to do what we need to do, which is get on the phone, build the relationships, shake hands, mix and mingle, get out there, right? And show people the value and the service that you provide. That was really speaking to them. And again, only you will have the answers. But in this case, that is a big piece of what drove their revenue growth. And it was also the referrals that they got from amazing jobs being done over here, right? So hopefully that makes sense for you. Okay. So now, just some other things to watch for. Now we've got a -14. So again, lessons to be learned from this. I've seen this over and over and over and over and over and over and over again. Every year we get profitable years, it's like money in our bank account, right? Our personal bank account, when we see extra money sitting there, we're like, oh, I'm rich, there's extra money. Let's go buy a new piece of equipment. Let's go buy a new building. And I can hear the chuckles because this is what happens. And this is exactly what happened to this company. So when you have retained earnings, make sure to set some aside, right? We need to have, just like we need in our personal lives, we need a safety net for the business, because despite our best intentions and despite our path and our strategy to profit, things happen externally, you know, recessions, oil, like there's so many things that go on that are outside of our control. Just like we need at home, we need a safety net to make sure that we can ride out a storm. And, you know, unlike at home, it's not a month or two, you probably want at least 6 months to a year of a safety net. So until you have that safety net, my recommendation, despite the taxes, is to make sure that you're getting that, you've got that security before you start investing in other pieces. Because oftentimes those investments aren't necessarily always going to make you money. It is super important to know all the costs attached to it, because in this example, look at what happens. They bought a building and they bought equipment. So their space and operating expenses went from 8 to 14%. 8 to 14. Their total indirect costs, they were sitting at 15 here in 2011, and in 2012 they went up almost 10%. 10%. So that happened. Under direct costs or cost of goods, they went from 65 to 90%. So this is kind of like, okay, where did we go wrong that year? Okay, well, obviously all of the carrying costs now of the new space, plus the maintenance of the space, the loan on the space, the interest on, like all of that. And it's interesting because when you actually calculate the appreciation value of property minus the interest charges that you're getting on it, you could be sitting anywhere from a 1 to maybe a 3-4% net profit year over year on that. So then the question becomes, can you find a better investment somewhere else, or are you okay with making that 2 to 3% on that property and including taking off all of those operating expenses of it? So just be really aware of what you are starting to buy when it comes to capital assets. Okay, so what happened here? We can see material costs went up slightly, blueprints went down, subcontractors. Wow, so subcontractors went up from 16 to 21, wages and benefits went up to 38.85, right? 38.85, it looks like they were paying themselves rather richly, right? 38.85, a 485. So something to think about. You want a fair market salary. You don't necessarily want to get high on the hog, right? So again, only you know the answers to why you're profitable and why you're not profitable. So something to think about. What else do I want to draw your attention to? I want to draw your attention to our revenues. So one of the questions I'm going to ask you is, what product or service brings in, excuse me, brings in the most amount of money for you? Because you might be finding some interesting discoveries as you go through this. So in 2013, they had 62.75% of their business came from renovations. And then house sales at 37. It remained flat for 2014. Although their sales, they had a 47% increase in sales. So that's a nice touch there, right? 2015, we start to see some changes. So 56% now is renovations, 43% in house sales. 2016, they dropped down to 19% in renovations. House sales 11, miscellaneous income 68. So again, this is not telling us much. This is why going forward, we want to separate, because what is miscellaneous income? Here they had to guess. Right? They're like, well, it was mostly house sales, but there was also some financing that, like, it was all kind of jumbled up together. And then 2017, their renos go up a little bit, but again, 73% here between home starts, house sales, and miscellaneous income. By house sales, I mean new house builds. So it's interesting because their revenue started to grow. And this is something I want you to watch for. If your revenue consistently is growing, this is usually an indication that the market really appreciates what it is that you have. You're good at what you do. But again, I don't want you to get caught up in top line sales, right? We do not evaluate the success of our business by top line sales. We evaluate it by bottom line profitability. So although their revenues have been growing, their net profit has been declining. And in some years, they have taken huge hits, especially this year, which was, I think, 2017. They were negative 14%. Now, I can tell you right now, when you start to look at this negative 14, they called me in here. Well, they called me in 2018. They still didn't have 2019 numbers done. They're sitting at 1.95 million. By the time they were done 2017, they were sitting at 4 million in sales, so a whopping 110% growth. But by the time we figured all of this out, their net profit, they were actually sitting at about negative 25. Why that is so important to you is because a lot of people think that all you have to do is grow top line sales. And that's originally why they brought me in. They said, just help us get more money because we've got something going on that's right, and that's great because our growth is phenomenal. But what was happening is that with their top line growth came bottom line demise, and it kept eating away at them. So one of the things that we pointed out very quickly here, and you can see this, although we don't have, we do have the expenses, they put all of their cost of goods just in one bucket called materials. They were running kind of ragged at this point. They had made a change in bookkeepers and accountants. Everything was kind of skewed, but at least they had that number. And I know you all know the answer to this. Can you operate a business at 110% cost of goods? There's no way. You still have operating expenses. And that's exactly what happened. Their operating expenses, look how lean and mean they got. They got down to 3.79. I can tell you this was not healthy. They weren't paying themselves. They sold everything off. They got rid of their space. They got rid of their equipment. They were in survival mode at this point. And survival mode, they still came in at -14. So this is why we do this work. This is why we plan for profit, because this cannot be you. There is no way, especially after this challenge. Absolutely not. So here's what I want you to do today. I am going to be emailing these questions out to you. And these are questions that I want you to really give thought to. And I still need to fine tune some of these, but it is not an open-ended question. I want you to dig in and figure out why or why not, right? Because that's where the gold is found in this whole exercise, is to figure out what was working and what wasn't working. You've got the percentages. You now know where you need to start digging in and fixing things. So I want you to take a look at, when it comes to profit and revenue, what year was most profitable? Be able to answer why was it profitable, right? What year was least profitable? Why? What was going on? Just so that we know that we're not going to repeat these things going forward. Under profit and revenue, has there been slow and steady growth with sales? Why or why not? So I talked about the slow and steady growth usually is indicative of a market appreciating what it is that you have to offer, there being market demand. Sometimes if you've experienced a dip, it could be an external situation. It could be something to do with the economy. It could be something to do with a specific industry, oil and gas. So if we know that those situations compromise your revenue, we better start looking for ways to fix that, right? Maybe some not duplicity, but some redundancy with a service in a different industry. So come another boom bust, right? You're not dependent just on oil and gas. You've decided to diversify into a different industry so you could get 20 to 30% of maintained holdings with respect to your revenue. Again, just lessons to learn from. Product and revenue. What product or service generates the most revenue and why? You might not be able to answer this. If you have not broken out your revenue buckets, then you won't be able to answer this. And this is why we break out the revenue buckets, right? What product or service does our market base love, and why do they love it, right? So let's put that together. You might also even want to take a look at what product or service is least attractive to your market, because there might be, there might be a situation there where you might decide all of our money and investment in isn't worth it. This has just been sitting here and nothing's been happening with it. You might also find that you have some products and services, I call them lost leaders. So they bring in tons of business to you, but they don't make you any profit. But when they come in, now you start to add value and services in addition to that, right? So now that you've created awareness with them and you started to build a relationship, now if you sold them A, but you don't make money on A, now you sell them B, C, and D, and you make money on those. So those are what are called lost leaders. But again, none of these questions we can answer unless we've charted the data. And going forward, again, we want to make sure that we're budgeting properly to be able to answer these questions in the future, because these are the questions that you should be asking of yourself every month, every week, and definitely a board is going to be asking you these questions. So when you get your business to that level where you're thinking of, I really want to become a serious business, a viable business where I've got a board of advisors or directors holding me accountable, because maybe you want to go for an exit, or you want to be able to have some sort of succession plan or strategy, this becomes bigger than you now. And these questions will get asked of you. So this is your training ground to be able to ask yourself these questions. Okay, did you introduce new products or services into your revenue model? Why or why not? Oftentimes what I see here, just like we saw, actually, nope, this wasn't the example in this case. In this example, these guys were actually doing really well with renovations. What happened is they started to get bored. They wanted a new challenge. So they decided, let's start building homes. We're doing so well with renovations, let's start building homes. When we started to do the forensic analysis on all of this, it was the homes that was costing them money. They were literally paying each customer $10,000 to build a home for them. They were making zero money, 10,000 off the top, right? So we need to be very aware of why are we introducing new products and services? Is it going to be financially viable? But the other thing I see often times is that when one product or service isn't working and you're experiencing a negative net profit, the entrepreneur's solution typically, because we're the butterfly chasers and we like the sparkly bright things, we're like, oh, there's another one, oh, there's another one. We think that if we introduce a new product or service, that that's going to fix the problem. And I'm going to suggest that that is highly unlikely. It could be, but it's highly unlikely. Until you actually learn how to create a financially viable model, right, which is what we're doing with planning for profit, make sure your foundation is solid, that you're rocking it, that you know how to make money, bottom line money, and top line money, then introduce a new product or service, then start a new business. And I say this with love because I've done this too. I have 3 businesses right now. One I had to put on hold, saying I can't touch that one until these 2 are at this point, right? Each one has their own milestone. I had to learn too from my mistakes. And again, remember, if you've watched the intro, I've gone through bankruptcy, I've lived through insolvency, I've done it all, right? So I'm speaking to you with love, compassion, and empathy, so you don't do what I did. Direct sales. Here's the questions I want you to ask yourself. What product and service is most profitable? You're not going to be able to answer this if you have one bucket of all the direct sales in that as a percentage of revenue. And most of you, that is going to be the case, at least 95% of you for sure. So don't worry about it. But the learning in that is that, my God, I don't know what product or service is most profitable. I better change that going forward, right? Because your board is going to be asking this of you. Are your cost of goods or direct sales, are they calculated by revenue stream? Why or why not? And oftentimes the why not is, I didn't know any differently, right? My bookkeeper didn't tell me and my accountant didn't tell me. This is why you're doing the work now. So high fives to you for actually realizing that we need to do things differently. When were your cost of goods highest and when were they lowest and why? So going back to those numbers to go, we took way too much money out here, we paid subcontractors way too much over here, we got really sloppy with our materials over here, or maybe there was some really brilliant efficiencies that you managed to factor in there too. So just making sure that all of that's coming together for you. Which cost of goods are highly variable, leaving you most exposed? So this is important from the perspective of, there are definitely going to be some things like when you get to fuel, shipping, duties, exchange rates, right? You're going to have very little control over all of those things. We need to change that. We want to make sure that you do have control over those things so that we are over budgeting. We are making sure that you are never compromised again when it comes to your cost of goods. So that if we know that you need to come in at 43.2% as a cost of goods, you will always come in at that number. And if you don't come in that number on that week, we know that we're going to have a price adjustment very quickly, right? Or renegotiate with a supplier. So that's a question for you to consider. Which cost of goods are not being accounted for? So what have you missed here, right? What have you missed? And then also, which cost of goods should be recorded as indirect sales? So an example here is things like the wages and benefits. We should be taking those out of cost of goods, putting them into salary. In this example here with my lovely construction example, you will see under space and operating, they had some expenses like freight, which really actually should have been a cost of goods, as well as licenses and bonds. These were actually licenses and bonds attached to specific projects. So these should have been cost of goods. We don't need to fix it in the past, but we definitely need to fix it for the future, right? Okay, your team, questions I want you to ask. Do you have the right number of people on board? Too many, too few, right? Why or why not? In most cases, well, actually that's not true. I've had a couple clients where they have way too many people, but in many cases, we actually don't have enough people, right? We're trying to do everything ourselves. So when we move tomorrow into operating expenses, I'm going to start to get you to think as a business owner. not the individual who started the business. You're not the startup. You are the general manager and CEO of this business, and your job is to make sure that the business runs efficiently. And that probably means that you need to get some other people into the right roles at the right time and pay them appropriately. And I'm going to get you to budget for that, because I want to make sure that not only are we budgeting for profit, but we're budgeting for efficiency, and we're budgeting for a sustainable business model. Do you have the right people in the right roles? Oftentimes I can see very expensive people doing I don't want to say low task work, but they are doing work that a minimum wage worker could be doing, but they're getting paid $50 an hour, where that minimum wage person would be getting 15 to, you know, 30, whatever, 15, 16, $17 an hour. And meanwhile, you're charging, or you're billing out, you're paying someone $50 an hour, and you're doing it because that person is there and they're able to help you, but it's compromising your business. So we need to watch for that. And then most importantly in team, are you paying yourself a fair market salary? For a general manager, CEO, depending on the scale of your business, we need to make sure that we're accounting for that. Usually in all of these cases, the why not is because, oh, I don't have money for it, right? Space and operating, couple quick questions. What expenses should be recorded as cost of goods, right? So well, we just went through the examples with the freight, and we went through the examples of licenses and bonds. We should be taking those out and putting them into COGS. And then what expenses aren't being accounted for, right? Are you missing things that don't even show up in Chart the Data, right? That you're like, oh, you know what? We really do need someone answering the phone. And that doesn't need to be a person, that can be software, right? Maybe you need CRM software. Maybe you need, you know, new equipment. Maybe there's things that you need that you are bootstrapping and saying, no, 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 can't afford. I want you to start thinking about what those things are. And then we've got sales and marketing. So how do you measure the return on investment of your marketing efforts in the past? And what percentage of revenue did you spend on marketing? Did you see the return on investment the following year? Why or why not? So here's what I want to show you, is that when we go back over here and we do the highways and the hazards, this isn't the greatest example because these guys were like guerrilla marketers all the way. Referrals, handshakes, one of the partners is actually brilliant at building relationships. But oftentimes with sales and marketing, especially if you're doing trade shows and you're traveling and blah, 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 you can see sales and marketing expenses come up to 4, 5, 6, 7%. Then my question for you becomes, and again, this isn't the greatest example, but if you're spending 7% on marketing in this year, we expect to see at least a 14%, right? You want to double your return on investment. You don't just want to break even. So if you're spending 7% on marketing in this year, did you get a 14% lift on your revenue the year after? If you're not doing that, something's happening with your sales and marketing. You are not getting that return on investment. It's not working for you. You've got to stop the bleeding. So these are the questions that I'm getting you to answer in here under the sales and marketing piece. And then other questions, are your bank fees and interest, are they combined? Because if they are, we're going to have to separate them, right? Bank fees are a part of our operating. Interest can become a part of the other with your loans, excuse me. But here too is another really good example, because oftentimes bank fees get lumped together with merchant fees. And in many cases, merchant fees is part equipment rental and then part transaction based. So it should be cost of goods, right? Because it's 2.73% of every credit card transaction that is applied to the transaction. It's not a base marketing or not a base operating expense. So we're going to talk about that going forward. And then amortization of equipment, is that accounted for? Don't worry about that so much today. We'll talk more about that tomorrow. I feel like that was a lot for you. Geez, every time I do these, I think, oh, I'm going to be 20 minutes, 30 minutes max. And I just go on and on. So hopefully all of that was relevant to you. It was educational for you, and there was value in that. And I wasn't just ranting for the sake of ranting. Again, this is my first time doing online. I hope today's exercise is very clear. I just want you to review your highways and hazards, right? Just go over here to review the findings, see what shows up for you. right? And then I'm going to email these questions out to you, and I would love for you to give each one of these questions thoughts, each one of these questions, the thought and attention it deserves, and be able to answer why or why not. Because once we have those answers, now we can start moving over tomorrow into operating expenses and figuring out exactly how we need to start budgeting appropriately for our indirect expenses so that we end up with a profit. All right, that's what I've got for you. Now, today, I apologize, I have to run because my daughter forgot her lunch and she needs to eat, so I need to go drive that to her. I'm probably going to send out a little later just a link. If you want to do a Q&A, you can absolutely jump on. I'll open up Zoom again a little later today for you. Otherwise, please, yesterday you ended up emailing me all your questions. That was brilliant. Texting me your questions, I love that too. So I can certainly hop on the phone. I can respond to your questions. I love them when they come in email format, because then I know I've kind of got a record of the questions that you've got as well. Before I go, I see one question in here. How do you manage WIP or deposits as you can't show as income but aren't accounted for inventory purchased and etc.? Okay, Jared, I'm gonna have to speak to you just to find out exactly what you're looking for there. I'm assuming this is this kind of like your project-based going forward and your milestone or your progress-based billing. We can talk about that when it comes to when we get into revenue streams and mapping those specific assumptions out. But thank you for that. I'm going to wrap my head around that so that I can give you that answer. Sorry, that wasn't much help to you right now, but let's talk about that when it comes into receiving those deposits and revenue streams in day 4, and then next week we get into that as well. Oh, I can see lots of questions coming in. Thank you everybody for those. Okay. I apologize. I am going to run, get my daughter fed. Please email me your questions or text me your questions. And a little later today, I'll just open up the Zoom room again. It's probably going to be after 4, 5 o'clock. And if you get a chance, pop in there and we can have some extra dialogue. Okay, I'm going to leave it there. Okay, I think that's it for everybody. Everybody's dropping off. Okay, thanks everybody. Thanks for your understanding today, and look forward to your questions. We'll see you tomorrow, same time, same place. Bye for now.